Well, the most important concept to grasp when managing money, in my humble opinion, is the second derivative of inflation in the context of growth. I believe the $5 trillion that was printed over a COVID disaster, it's just taking a long time to come out of the system. So I'll give you an example of what I'm talking about. So we talked about the reverse repo facility that was at once $2.5 trillion in the summer of 22. It's now down to just a couple of dozen billion dollars. So that's out of the system. But there's still about $700 billion in the Treasury general account. That's liquidity out there. And then I was looking at the reserves in the banking system. There's a tremendous amount of reserves out there. There's over $3 trillion in reserves. You think about we'll put that in context, Mr. Pento. What does $3 trillion in reserves look like historically speaking? Well, if you look at prior to the global financial crisis, there was like $50 billion of reserves in the system. And now there's over $3 trillion. So you ask yourself, what's going on in the economy? What's going on in the markets? Well, what's going on in the economy is that the lower 3 quintiles of consumers, so the bottom 60%, are decimated. They're wiped out. Inflation has crushed them. That's why defaults and delinquencies are a 5-year high. But then you look at the top 2 quintiles, especially the top quintile, and they're doing great. They've never been better. Their houses haven't gone down yet. Real estate portfolio is fantastic. Their stock portfolio is doing great. And that's keeping the economy running. So you have all this liquidity out there, which is boosting markets and keeping the top 20% healthy and paddling along very vigorously. Let me say parenthetically that I am not yet short the market, but the market is so expensive now that even though it's not going to crash imminently, there's just not a lot of room for it to go higher. So if you look at things like the total market cap of equities to GDP, or the price to sales, the S&P 500, or the median PE ratio, the Cape-Shiller 20-year inflation-adjusted PE ratio. If you look at things like risk premiums, which are negative now, so you take the inverse of the PE ratio and you subtract something like a Treasury from that metric, and you say, wait a second, I get paid more to just own T-bills than I do with the earnings yield on stocks. That's very, very rare. So you buy stocks, you own a lot of short-term bonds, and you wait. And one of these two things is going to happen. I don't know what the level of reserves in the system that causes a panic is going to be this time around. I know last time it was around $2 trillion. There's always more reserves that are needed in the system because they're backing all these assets, all this money that's been created. The reserves are going to tick down to a level that causes a repo crisis and a money market crisis. That's one. Or more likely, we're going to get a crisis in the long end of the bond market now that the RRP is down to basically empty. And you'll have a spike in long-term interest rates, which causes a problem in the stock market and in the economy in general. But until then, it's just like, hey, give me my 4.25% to 4.5% on T-bills. I'm going to be long a couple of key sectors like inflation hedges, like gold. I'm going to wait for my model to signal when the money markets begin to freeze. The money markets always freeze first, and then the stock market will crater, and then the economy will tank. That's what I'm doing. It's inflation and solvency, as always. So you look at the supply and demand of treasuries. It's a tsunami of treasury issuance that's going to happen, regardless of what Doge does, because they have to tackle Social Security, Medicare, and Medicaid. They're not doing that. Defense, that's going to be a tough nut to crack, and interest on the debt. You're going to have $2 trillion deficits as far as the eye can see, and that's the good news. What if we get a recession? Then the deficits go to $6 trillion automatically because the revenue shrinks and the stabilizers kick in. So you're going to go to $6 trillion. Who the heck's going to buy it all? And at what price? The price is going to be much lower, and the yield's got to be a lot higher. So you look at the inflation dynamic along with the supply imbalance. Well, we have a very hard time getting inflation under control in this country. The Fed says that they have a 2% inflation target. Do you think that the Fed has reached that 2% target anytime in the recent past? The Fed has missed its inflation target to the north by almost 4 stinking years by their hedonically manipulated that they use called the CPI. And even if you look at the PCE, that's not a 2% either. And core PCE and super core, you can measure it 6 ways. Listen, the level of prices has already bankrupted the bottom 3 quintiles of Americans. So it's not that people are saying, oh, I'm so grateful, Mr. Powell, that inflation came down from 9% on a rate of change basis to 3.5%. No, it's rising further and faster away from a level that allows me to support my family, to buy groceries, to own a home. to pay for insurance, to pay taxes. So that's the real issue. So if you have inflation that's running, quasi-intractable, and here's the punchline, they have a bias towards easing. They were easing. They cut rates already by 100 basis points, but they still have this easing bias. Well, why do they have an easing bias when inflation is 4 years north of their target? When you have insolvency and you have inflation, that's what the long end of the bond market is always concerned with. And that's why yields are rising, and that's why your cost of your home, which is already, as a home price to income ratio, is at a record high. And when you throw in maintenance and insurance and taxes, it's out of reach. And then you say, well, wait, now the mortgage rates are going higher. They're up 100 basis points since the Fed decided it was a good time to panic in September of 2024 and cut rates by 50 basis points. That's your answer. That's where your real problem could be. Now, I'm not saying it's definitely going to happen. I'm not saying when it's going to happen. But you have those two real risks of when you're going to have a freezing up of the money markets. And that will cause the stock market to tumble, and that will bring down the whole house of cards. But until then, you hold your short-term bonds, and you could hold your inflation hedges, and you can make some money while you wait for what I call the grand reconciliation of asset prices to occur. And why do I say that? Because when you look at things like the Buffett indicator, which is the total market cap of equities to GDP, currently sitting well north of 200%. So when the valuation of equities, the market cap of equities, is over 2 times the level of annual GDP, which is extremely rare. This is a new phenomenon. The normal metric here, the normal ratio, is south of 1. It's over 2. Stocks have to correct dramatically. Real estate has to correct dramatically. And also bonds. And I'm talking about corporate debt. There's a huge bubble in corporate debt. That has to correct. If you think things like private credit, something that never existed before. This is a new invention by Wall Street. Hey, the shadow banking system is saying, you're a business, you can't get a loan from a bank, and you can't tap the corporate bond market. Well, come to us and we'll give you a loan. And there's $1.5 trillion of that stuff out there. Now, when we have a recession and people are going to call up their friendly financial institution and say, that money I gave you for that private credit loan, I want it back. We don't know what that market is, and you can't get it back. That's a real problem. I own an inflation hedged ETF, which has a lot of land in it that produces real assets, not real estate. So you think about gold mines and agricultural commodities. You think about energy, natural gas, oil. That's a wonderful hedge against inflation. There's a lot of reasons why gold should not be at record highs. We keep bouncing our nose against $3,000 an ounce. And you think about it, well, we're talking about interest rates. Well, interest rates, nominally speaking, have stopped going down. The dollar has been extremely strong. Bitcoin, there's an obsessive compulsive nature in the media and even in the administration about Bitcoin. I don't understand it, but that's stealing a lot of gold's thunder. Peace is supposedly breaking out all over the world. Ukraine, Russia, Gaza. The Doge in DC supposedly cutting out waste and fraud and abuse. So that's also very positive for our fiscal agenda going forward. So that should be negative to gold. So it just bothers me a lot that gold just can't go down. Have you noticed lately that the dollar goes up, gold goes up? Interest rates go up, gold goes up. No matter what happens. I've heard stories about a lot of gold coming into this country from overseas. Here's a theory for you. I've used my 34 years of experience in this business to analyze it, and I kind of believe it might have some credence. What if the Treasury's 261 million ounces of gold that they say they have isn't really there? And you have a new sheriff in town who's prone to doing a lot of audits of things like the Fed, maybe even the audit of the Treasury. What if they, being the United States government now, is scrambling to buy gold to replace what they've already loaned out or hypothecated or never had, those 261 million ounces of gold? That makes some sense to me because there's something else going on. It isn't a recession. It isn't a crashing dollar. It isn't a crashing economy. It isn't a crashing stock market. It isn't falling, plunging real interest rates. Why is gold where it is? You could explain some of it with inflation, but I think there's something else going on there. And I think what I've just mentioned could be a reason. There's 20 of them. I'll give you a few of those. I look at financial conditions. I look at credit spreads, a copper-gold ratio. I look at the net percentage of banks tightening lending standards. I look at the liquidity in the reverse repo facility, TGA, Treasury General Account. I look at the reserves in the system. And it tells me when the liquidity in the system is either contracting or is expanding on a second derivative basis, because that's all that matters. It's not the absolute change in inflation, for example. I don't care if inflation is 3%. I want to know what it was in the prior 3 months. rolling average. And then I'll compare that to the next metric and I'll say, oh, look, it went from 9 to 3. That's disinflation. That's what's important. I think this is one of the most dangerous times to be a buy and hold 60-40 target date fund participant. Through the decades, that's been inculcated over and over again to investors. Hey, the market never really goes down for very long because you have the Fed and the Treasury at your back. That's been true since 87, really, and that dynamic has been intensified through the years. But what happens when the Fed and Treasury can't save you because all they could really do is borrow, print, and spend, which is the very things that the long end of the bond market is most concerned about. Let's just say we have a recession and real estate crashes and the stock market crashes and the money markets freeze. You can't float commercial paper. The repo market is dysfunctional. And they come out with this program, they being the Treasury and the Fed, they say, we're going to expand our balance sheet to $20 trillion and we're going to send out helicopter dumps of money again. What do you think is going to happen to the rate of inflation? And how does the long end of the bond market respond? Don't forget, we haven't had a problem with inflation since the 70s and early 80s. That's when Volcker took Fed funds rate to 20%. 1980 is a long time ago. Who has been managing money or even participating in the market? What percentage of people can remember those days? But what they really remember is what happened throughout the 80s and the 90s is like, we can't get to 2% inflation. What are we going to do? They finally figured out how to get to, I knew it all the time. I said, all you do is print a bunch of money and then tell people they can't go to work and make anything. And they didn't just print money and hand it to the banking system so the banks could just buy assets and put bonds and real estate and stocks into a bubble. They handed it out directly to people. So the government just ran massive deficits, handing money directly to people, which was monetized by the central bank, printing money, handing it to the banking system. The banking system then bought these bonds. That's how they do it. The Fed can't directly participate in auctions, but they use the banking system, the primary dealers, as a conduit. But the conduit was to the people. So the people had money. So you had huge expansions in the broader monetary aggregates, M1, M2, and M3. So that's how they get inflation. And they're going to do it again. And where do you think inflation is going to go? And when does it stop at 9? No. I think you can run intractable. And then if you have inflation in the double digits, where does the long end of the bond market go? How much does it cost to take a mortgage out? What I'm trying to say is it should not be as easy as it was in the past when deflation was the big problem. That's all I'm saying.